You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from theoptionsinsider.com, and co-hosts, Uncle Mike Tosaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi, and Mark the Greasy Meatball Sebastian from OptionPit.com.
And welcome back to the Option Block. I'm Mark Sebastian, founder of OptionPit.com, and your guest host for the Option Block podcast. Now, where is Mark Longo? Mark Longo is somewhere in California riding on some sort of teacup ride. My understanding is his wife took him for breakfast with the princesses this morning, so he was super excited about that. And this is the Option Block, another one of the great ones on the Option Insider Network. Where can you hear all the information on the Option Insider Network? If you don't know by now, go listen to a show where Mark has opened up, because he will tell you all 9,000 ways to listen. So joining me, as usual, is my good friend, the man, the myth, the legend, Michael Tosaw. Welcome to the show, Mike.
Great to be here. Great to be here. Always excited on a Monday.
Oh, yeah, it's the best. Absolutely the best. So with that, let's roll on to the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the trading block.
And welcome to Trading Block. Let's talk about what is going on in the market. Well, quite the day today. We saw the market take a rather large turn from down 11 to up almost 11 points. The S&P 500 closed 2102.44, up $10.90. The NASDAQ 100, the NDX settled 45.67, and the Russell 1224.35. All of them up near. The Russell up about 1%, NASDAQ up 0.75%, and the S&P up 0.5%, respectively. If you're one of those Dow watchers, up 67 points, 0.4%. The VIX settled 13.04, up about 21 cents to 0.2%. And all told, kind of a screwy day, Mike. What did you think of the action between 8:30 and 10 o'clock this morning? What was that?
Man, this would be like a great day to be John Griegas from Options Express if you're a day trader. If you caught that move as a day trader, you are a happy man right now, or woman for that matter. Just seeing us open down like we did, and then just taking the turn like we did. And actually, if you look, probably around a little bit after 9:30 Chicago time, it looked like we were going to go right back down again, but nothing happening. We just went up. The bulls just kept running and running and running, and it looks like they're still running even into the close. So today was an exciting day, to say the least. That's for sure.
Yeah, and absolutely. Kind of a weird one. We saw the VIX was up nicely on the open, 14.5. But what was kind of interesting is we didn't see a lot of price action out of the futures. A little bit in August, not much in September or October, as they were kind of pricing this in. And really, even with the VIX's kind of huge turnaround, SEP only settled down about 10 cents to about 15, and OX settled down about 10 cents to 15.75, 15.70 now. So really just a screwy day. Now, there was some interesting action that happened. You'll like this one, Mike. The Morgan Stanley boosted their price target for Tesla from $280 to $465, a increase of 66%. What do you think? You a buyer of Tesla going from $280 to $470? That would put Tesla, if you look at Tesla's market cap right now. Give me a second here. Tesla's market cap is about $31 billion. General Motors is $49 billion. So if you increase it by 66%, that would make Tesla as big as General Motors. It would make it almost as big as Ford. It would make it much smaller than Toyota. So Toyota would be the only one with any real size. So what do you think? You think we're looking at Tesla going to be the largest car company in the United States? What do you think?
Well, a couple things on that. First off, let me address General Motors. You're forgetting about General Motors is it's government motors, so they're technically not. They're probably not 49 billion as market cap. They're actually 13 trillion in debt, because that's technically what General Motors is for the most part. In case they go bankrupt, they got the government put option going. But to add to that, I think it's interesting that after the earnings call that Tesla had a couple weeks last week, I believe it was, when they announced that they're losing approximately $4,000 per car, gives reason for an upgrade. Now, Tesla right now, they seem to remind me a lot of Amazon in a way, in that, no, we're not making money, but who cares? We know that we have the best product, and who cares if we ever make money? We're just going to continue to make such a great product. The other thing that I find interesting about Tesla that actually might be a case for them going up is that, yes, they are a six-figure automobile. So one person might make the argument that, well, if we have a tougher economy, then that would be tough on Tesla. I don't think it would be necessarily, because people that can afford $100,000 to buy a car can also afford $100,000 to buy a car even if we have a bad economy typically. Second thing about it, some people have made the argument on Tesla that because oil prices are so low, well, you don't really need the electric car anymore because gas prices are so cheap. Well, once again, people who are buying Teslas are typically people who aren't concerned about paying an extra 37 cents at the pump. They're more concerned with, number one, having the status symbol, typically. Number two, perhaps preserving the environment if you're a rich person and believes in that type of thing. And also to have a great car. Everything that although I've never personally driven a Tesla, everything with which I've read and heard about them seems like a very well-handled machine.
I have driven one. They are nice. And now they're losing $4,000 a car, but where they're making all sorts of money is on selling their the environmental credits. So that changes the dynamic of the car. But this Model X is going to be I think a resounding failure. And they are doing some really cool stuff. That car is unbelievable. If you ever get a chance to get a ride in a Model S, go for it. I think Mark and I talked about this some. I thought with the SUV they should have gone after your Cadillac Escalade buyer, not your Cadillac SRX buyer. Does that make sense?
Yeah, I would. I mean, I'm going to be, because of the fact that I own snowmobiles, I own a boat, I'm going to need to have some type of vehicle my entire life that pulls those type of things, and I'll need some type of a four-wheel drive type SUV, whether it's a pickup or something along those lines. And I agree. I mean, I think that's one to where if you're looking to buy an SUV, they're going after people that would buy a Cadillac Escalade.
Yeah.
So I don't think that was a wise move necessarily, or that would be a wise move to necessarily go after trying to sell a utility vehicle to a performance customer.
Yeah, that's just it. Now, these cars have a ton of torque, so they can pull. They obviously technically don't have horsepower. So one of the interesting things is, how like a car, a Tesla has, if you ever see a Tesla and a Ferrari race, Teslas are faster than Ferraris for the first I don't know, the first 2 or 3 seconds off the line because they have that much torque, because they literally go from 0 to full power with the push of a button, where an engine like a traditional combustion engine really shows its teeth is in the horsepower, where they can actually pick up more acceleration and more strength as they speed up, and an electric vehicle can't do that. So it's an interesting little thing. I think that I don't know that I would have bought I don't know that 465 is in the cards, and that seems a lot more like panic than anything else. Now there are some other names out there. So Zulilly, you ever heard of Zulilly?
Not a Zulilly man, no.
They are a interesting company. They're an online retailer and standalone. Lauren's done some stuff with them. They're interesting. They make money. They got a small market cap. They just went public today, up about 7. Well, nope, they didn't go public today. They must have had earnings, because they're up about $7 today. That's some good stuff. The Pentair, Estee Lauder had earnings, so some things out there. I think the most interesting name that I saw, the big news on Zulilly was Liberty Interactive is acquiring, they're being bought. Oh, well, there you go. QVC is buying Zulilly, and Pentair agreed to buy Irico Global. Don't know anything about them. So now let's look at Estee Lauder. This is the last one. They make makeup. They've had all sorts of problems with the U.S. dollar, and it's causing them all sorts of interesting pieces. So, those are kind of the stocks to watch. Now, there was an interesting headline that I wanted to throw out your way before we move on Wall Street Journal. The Wall Street Journal had an article that, the next stock market might be much worse than the NYSE, and do we need to have more competition in the exchanges? And before I answer, I'm gonna ask you, what do you think, Mark? Do we need more stock exchanges?
I would say they're kind of. It seems to me like both stock and options exchanges are starting to get to be like Starbucks. There's one on every corner, along with McDonald's.
Yeah, the last thing we need is more stock exchanges. The move, the seamless move of the NYSE going out of the market, I think should be kind of explanatory that really everything is fine. There was some interesting thing on gold. Gold's actually found some sort of bottom. What do you think about gold? Why is gold finding a bottom here?
Well, I think you have let's look at GLD just as an example of this, because I know a lot of our people out there that do look at gold are into GLD. We actually bottomed out around the 103 area in GLD, and so with that being a key number, I think that could, number one, have something to do with it. It's got to have a bottom at some point. I think that's one area with which to kind of look at it. It's never at the exact bottom. Very seldom do stocks, options, or anything for that matter bottom exactly at a specific number. So I think that's probably the main reason. The other one is the fact that at some point this dollar rally is going to fizzle a little bit. And just as a precautionary measure, if I am some type of a big institution, if I am a country like China, well, maybe not like China, but if I am someone who has investments in currencies and very large dollar things, I'm going to be looking to start to get some money into gold because of the fact that over time, we are going to have inflation over the long run. Over the short run, like over the next couple of years, maybe not. But at some stage, I really do believe we're going to have an inflationary economy again. Should that be the case, gold will benefit from that. And the fact that if you look at a chart of GLD, for example, when it was in the 180s a couple of years ago, we're down almost 40%. Thank God for put options, I just want to say as a side note. And because of that, we're down so far. We will likely go back to an inflationary economy at some point. The dollar's not going to go up forever. At some stage, when those things change, it's going to make sense to be into gold. And I personally believe that the combination of all of those things is a reason that people are starting to get into gold again.
Yeah, I mean, it definitely looks like it got pretty low, close to a bottom. The dollar, I mean, just there's so much pushing it higher. Europe, Japan, China now. I mean, there is all sorts of forces pushing the dollar higher, which gold is a pretty good measure of kind of deflationary and inflation. And, with the strength of the dollar, there's just, at least in the next year or so, I think it's hard to see a lot of inflation other than, maybe some things we're seeing here in Chicago, which leads me to oil. Oil, boy, it just never ends for oil, does it? I mean, what did you see today? Finished the week at 42.10 last week, and I think settled lower today.
Yeah, I think with oil right now, it's still kind of one of those things to where I'm a buyer of oil more than I am a seller. I think that it's like I've said on the show 100 times. If you have a little bit of cash laying around, I'd recommend buying a few shares of XLE and sitting on it, just because of the fact that even if XLE, and XLE is the energy stock ETF, by the way, even if it just sits there forever, you're getting a dividend by the lesser amount of money that you're paying at the pump. Now, in regard to oil itself, we have a lot of supply of it right now. We have a lot of supply from the standpoint that we're actually drilling in America more than we ever have. And combine that with the fact that there might be a little bit of nervousness that one of the biggest buyers of oil in the world, China, might be slowing down a little bit. So we have those factors that are working against oil. I think like gold, at some point it is going to turn around. When? I don't know. Hence the reason I'm actually doing the voodoo thing on this show and recommend someone just buying actual underlying instead of an option. I know that's a horrible thing, and I know at all the meetings, that all the secret option meetings that we have, ladies and gentlemen, these guys make me do all the mean things that you see on TV that you have to do at all of the secret society meetings. But nonetheless, I think that at some stage this will rebound. But in the near term, like over the course of maybe the next, I would say 3 to 5 months, I think we're going to be sideways at best.
Yeah, I mean, I do believe that we're getting somewhere near the bottom, but we're not there yet. And if you look at oil vol, you can tell people are less nervous about oil because we have oil below $42 a barrel, and we have oil volatility below $42, 42%. And the last time we got here, oil volatility was in the 60s. So there's definitely some calming of markets, and oil, I think, is forming. I think we could see, if they don't raise rates in September, a rally in oil. I think we could see, something involving this Iran deal. If the U.S. decides to start exporting WTI, that could make a big difference. And, there were some rumors about that starting up here in the near future. So, with that, I think we've hit everything in the market. Let's move out of the trading block and into the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the odd block.
This is the odd block, and this is the section of the show where I'm going to talk about some strange and weird trades that maybe went up today. Maybe they're not that weird, but it's worth bringing up. So the first trade is Williams Company, and Williams is being WMB. They are being actively sought after by a couple of different firms. I believe they actually have a public bid out there right now, and a trader with Williams up about $2 today, trading at about 54 to 30 at the time. Right now, I'm going to look. Williams closed almost 55, 54.90. This morning, a trader bought 1,000 SEP 55.62.5 call spreads, 352 over 87.5. They actually traded this twice, trading a couple of blocks. Total average daily volume about 39,000, so nothing crazy, but this looked pretty good because it was definitely a straight bullish trade at the money. Someone that really thinks they got a shot at making some decent money on a proposed takeover, and someone that clearly believes that eventually Williams is gonna buy into that one. So I like the trade, and it's one I would consider piggybacking. I don't know if you've been following that one, Mike.
Yeah, I mean, I'm just looking at the notes we got today. So, yeah, it's one where I'm always a fan of if you're going to speculate on something and you have a higher volatility typically, because if you're looking to speculate on an event, like in this case it would be a takeover, I'm almost always a fan of setting up a call spread like this if you're looking to buy it. Reason being is that if the stock goes higher because this great news happens, then obviously you're making money because it's a bullish trade. But if it goes lower because it does not happen, a lot of times you'll have higher volatility because of the rumored event. You won't get caught holding the bag on the SEP 55 calls. You'll have at least something to mitigate the volatility risk by doing a spread. So if this is what your sentiment is, I like this trade all the way.
Yeah, I looked at it. I liked it, and one of the trades I thought about was you could have done this as maybe a butterfly, done the 55, 60, 2.5, 60, or 70, and it would have cost you about $2. Would have defrayed the cost a little more, but all told, not bad. Thought out, makes sense. Not a pay the broker trade as they call them. All right, next up, HIG, Hartford Financial Services Group, HIG. Trading around $49. It closed $49.16, near the top of its 52-week range. Paper bought 9,000 AUG 49 calls over the SEP 50 calls, so trade about 18,000. Traded 73 and 48, $1.48 respectively. Open interest about 26,000 contracts, and about decent sized trade, so an 18,000 block. So went up over 2 blocks, and it looks like a sell to close on the AUG calls and a buy to open on the SEP. So it's somebody that thinks that it's something that somebody wrote, somebody that's long the 49s in HIG thinks they're going higher, and so they rolled back to SEP and up a little point, and likely a bullish play. So kind of an interesting trade, certainly unique, but it sounds like the guy thinks the stock's going higher. So I'm not one to judge, but looks like a close open.
Yeah, I would say the same thing. I just kind of wanted to wear like the old 50s song, "Give me just a little more time."
Indeed, I like it.
That's what it looks like on this one.
I love it. How about the final one, which is Xilinx? Remember Xilinx?
I do.
They make they're a chip maker. Used to be a real hot stock in the 2000s. I mean, that was up there with, it was them and Novellus and
Juniper
and all those crazy stocks. So Xilinx XLNX settled around $43.93, up about 50 cents. Xilinx is near the middle of its 52-week range, so middle. They traded the AUG 28 weekly 44.5 calls for 70 cents, and went up as one piece total volume all day. Bought a bunch of these. A little interesting play. I don't think they've got earnings coming up, so they bought 1,700 of these all day in the weeklies directly, 50 cents out of the money. So this is somebody that thinks this stock is going to move a lot in the extremely near future. What do you think, Mike? Xilinx middle of the range. We just saw, we've got this Altera deal with Intel. Somebody thinking a merger partner, or what do you think?
Well, on this one, I want to reiterate what we had talked about on the Williams Company. I don't like this trade personally. Now, obviously, if the stock doubles in a week, then I'm the idiot for saying such a thing, but this is a situation to where you're buying a lot of premium on here. And unless you really think that implied volatility is a lot lower and that you're just getting a steal on these AUG 28 calls, I don't like this one bit. I think that with what you're looking to do here, unless you're just 100% positive that this event that you're looking for is going to happen, or this increased movement on the stock is going to happen, and it's going to happen significantly, because right now if the stock's trading at 43.84, that's still close to almost a 2% move that you need over the course of the next 2.5 weeks. Now, that's not out of the question with Xilinx by any means, but I think that there's better ways with which to play a shorter-term trade than just simply buying long premium. I think that at least, at minimum, a spread of some sort should have been considered.
I could not agree more. I think that makes a lot of sense. Could have been a real interesting and decent idea, but instead, no. So with that, that'll wrap up the odd block, and we can move right into the strategy block.
It's time to dispense options, wit, wisdom, and education. It's time for the strategy block.
And, of course, welcome to the strategy block. I am Mark Sebastian, and, of course, joined by Mike Tosaw, who, for a brief period of time, will manage to silence me. So, with that, I will pass the ball off to Mike and allow him to talk shop to me.
Got it. Yeah, and it's not easy to silence Mark Sebastian. Even with they have to get an extra powerful mute button on our technology to silence him, let me tell you. Anyway, the strategy block. What I want to go through today is kind of a little bit goes along with our odd block to a point. When to roll, when not to roll, why to roll, things along those lines when making a trade of some sort. The first thing that I want to talk about is, let's say that you're trading a short option, meaning you just sell a cash secured or even sell a naked put for that matter. My general rule on this, and I just want to briefly touch on this before I get into some of the more complex. We're starting out simple, and we're going to get a little bit more complex as we go today. Let's say that in theory, XYZ stock's at 50, you sell the 45 put, and XYZ goes up, or just a bunch of time decay happens, and you have the opportunity to get out of that same short put for 20 cents, I say get out of it. My general rule is that whenever I can collect 80% of the premium, I want to get out. I think that's a way with which to kind of set the table for what we're looking to do today and why it might make sense for you. Now, in terms of when to roll, let's say that you're doing a wheel type of trade. Now, the wheel trade we talk about on the show somewhat frequently. It's the Wheel of Fortune, Wheel of Fun, in that let's say you sell a put on a stock, you get paid to get into the stock because the stock goes down and you get the stock put to you. And then at that stage, you spin the wheel, you sell a covered call. Just a giant thing to where the stock stays somewhat within a range, and you feel that the premium that you're getting justifies spinning the wheel, so to speak, because you feel the stock's going to stay in somewhat of a range. Now, with that, I think that I'd like to expand upon when is it a good time to roll and when is it a good time to just get out and take a break. Before I do this, I want to tell you about the best trade of my entire life. This is when I was doing wheel trades. It was on ISE, the options exchange. This was probably about 10 years ago, and I was selling puts on it, getting into it. The stock would go up, I'd get called away, and just a lot of different things were happening. And it was a pretty successful wheel strategy, and I'll never forget it. One day I had gotten into the stock, and I had not sold a covered call. And the reason is that I was sticking to my rules, and what those rules are I'll go through in a moment. But this was one situation to where it really worked out in a very good way for me, because the next morning, it was on a Friday afternoon. I was working for Options Express at the time, and that following month, and I was watching my trade throughout the day, and I was doing an event I'll never forget. I was in San Antonio, and I was actually with my friend Steve Meisinger, who had worked for the ICE at the time, and he obviously didn't tell me anything about what was happening, and he didn't even know himself. But on Monday morning, the ISE opened up probably about 20% higher. And with that being said, I did not get filled on my covered call that Friday afternoon because of the fact that the limit order that I set was just too high for what I was getting filled on. So I thought, all right, well, if I could probably lower this by maybe a nickel or a dime or something like that and get filled, but I decided not to. And so needless to say, come that Monday morning with that trade, my wife was a nurse at the time. She's a nurse practitioner now, but she was a nurse at the time, and she was working nights. Needless to say, I was screaming so loud when I saw the news that morning that the ISE had gotten bought by Deutsche Börse and gone up 20% in value that I woke her up, and she was not nearly as excited about the trade as I was. With that being said, the rules with which I have on a wheel-type trade, I don't like to go more than one strike price away to the downside. So, for example, let's say that XYZ stock's trading in a range between 45 and 50. And maybe you sell it, your opening move is you sell a put for the 45 put to get into it. Stock goes down, you get filled at 45, and it's the stock you wanted to own anyway at 45, so you're fine with that. And then you basically got paid for getting into the stock. Then the stock goes up a little bit. Maybe you sell a 47.5 covered call. You get called away. Stock comes down a little bit. You sell a 45 put, and you're just continuing to do so. But now, that's when it's easy. That's when you're a genius. That's when it's fun. That's when you tell your buddies at the golf course, this is what I do. I'm a covered call trader. I do this. This is how I play with stocks. And you sound like just this great genius. But when it goes down, that's when you need to start being careful, and that's when you need to start learning as to what to do as to when to move on. I've made mistakes in the past, as we all have, but one thing that every wheel trade that I do from now on, I'll never sell a covered call. Let's say I get put the stock. I'll never sell a covered call more than 2 strikes, or I should say 10%, 2 strikes or 10%, give or take, below what I initially got into it for. Because let's say, for example, that I got put that stock at 45, and then all of a sudden the stock's down at 41. Well, okay, I get into it, and I sell the 42.5 covered call. Same thing, but now the stock's down at 37. Well, I can still sell the 40 covered call for the premium that I wanted, let's say. But then after that, let's say the stock's down at 36. That's probably even a little bit more than I would do in terms of staying in the stock. But at some point, you have to just get out of the stock and move on, because I don't care how many covered calls you sell. You're not going to sell covered calls until it gets to 0. You can, I suppose, but it's not a winning way to go with your trading. So my personal rule that I believe in for the wheel trade is once I get down below maybe 8 or 10% on the stock, it's time to move on. And in reality, I'm probably out a lot sooner than that. This is just on one that I'm really stretching with, on a stock that I would consider owning for the long term. That's where I would like to get out in the wheel trade. Now, let's say that you have the opposite problem. Let's say you get the stock put to you, and then you get the stock put to you at 45, stock goes up to, and then all of a sudden it's Monday morning, and the stock opens at 44.80, and you're just feeling so smart because you sold that put for $1, and you're thinking, wow, I got paid to own this stock that I would have owned anyway for a lot more than what this loss would have been. Man, I'm a genius. Stock goes up to 46 that day, and so you sell the 50 covered call. I'm sorry, the 47.5 covered call. And what the heck? You're the same premium that you would have accepted at 45. Why not go for it at 47.5? Great. You get called away because the stock goes higher. Now, at this stage, you have a decision to make as to where you want to get back into the stock. I say it depends on where it is. If I'm getting called out of a stock, this is the rule to the upside that I have and that I hold pretty hard and fast to. I don't like to sell a put to get into a stock higher than what I did in the first place. So, for example, let's say that the stock were to go up to $49 and I got called out at 47.5. Yeah, I'd sell the 47.5 put to get back into it. Why not? But let's say the stock goes up to $52 and there's not quite as much premium anymore because we've had a nice rally in the stock that we missed, by the way, because we got called out at 47.5. Well, if I have to sell the 50 put to get the same premium that I need, I don't do it. So, once again, the rules that I have for the wheel trade are usually 8 to 10% on a stock that you would be fine holding for the extra double super long term at absolute most of the time even less than that. To the upside, should a stock go higher, I never like to sell a put higher than what I got out of it for in a covered call to begin with. So with that, that's kind of some rules for the wheel trade. Now, let's talk about rolling. At what stage do you roll? Well, let's put those two things together now in terms of getting out for a profit and getting it so that when do you actually roll? Want to tell you about a trade from a couple weeks ago I was selling some puts on TLT, and I had the opportunity to get out for my 20% rule, and I was trying to go week to week as to what I was doing. Now, at this stage, because of the fact that I was able to get out maybe 3 or 4 days before expiration, when I was planning on holding those short puts till expiration, what I had the ability to do then was sell the following week for the same price as I got the current week at the same strike price. I took advantage of that. That was one that it worked out, and it was one where I was able to get the same premium the next week as well. So with that in mind, I'm a fan of rolling your short options instead of letting them expire worthless and trying to do something again on Monday. And I think Mark, and even the other Mark, and Andrew would even agree with me on this one, is that a lot of times you're better off rolling from 1 week to the next, or 1 month to the next, depending on or 1 quarter to the next, depending on what your time frame is, instead of letting it expire worthless and getting into a new option that following Monday morning. I think that's the way with which to do it. Why fight for that nickel? And a lot of times you won't be able to get the same premium on Monday as you could have on Wednesday or Thursday. Now, if it's Friday right before the close, then maybe just get out for a nickel and then wait the weekend. But usually I think it makes more sense to roll as opposed to trying to be, for lack of a better term, a perfectionist trader. Perfectionist traders are ones that they have to say, oh, I was going to get $1 for this option. I want to get my full $1. I don't care. I don't want to have to pay the extra commission and get out for 4 cents. I want my full $1 on it. Let it expire worthless. Not a fan of that. Now, in terms of when we would roll up, roll down, that's kind of one for another day. What I wanted to go through today was when we're rolling out, when to take profit, and things of that nature. So, without further ado, I'm going to hit the triple sensitive, extra double powerful mute button again and allow Mark Sebastian to talk.
What a great show. And with that, let's roll out of the strategy block and roll into the Sebastian block. And, and Mike, feel free to chime in at any given time. But, every once in a while I muse on kind of little points of life that are like trading and are like our job. And I was in Grand Haven last week, and I spent the week about a block away from a miniature golf course. You like putt-putt golf, Mike?
I am a pro.
I love putt-putt golf. And, the thing about putt-putt golf is there are really 2 ways to play it. You can play it for the lowest score possible, or you can play it for, trying to get par. And going the lowest score possible means you're going through the lighthouse. You're getting it through the spinning wheel. You're making it through the maze with your hit. Going for par typically means going around the obstacle, going, a less, really an impossible way to get a hole-in-one, but a far easier way of getting a hole in 2 or 3. It got me to thinking about trading because the one thing I noticed, and I was trying to teach this to my son, was that the way to get the lowest score was actually the way to get the highest score. And the way to get the safest score, the par score, was, for almost everybody, the way to get the lowest score. And that's a lot like trading. It's a lot like, like baseball. When you go for a home run, you strike out a lot more. When you go for a hole-in-one, you hit a lot more 4s and 5s in putt-putt golf. And in trading, when you go for a home run instead of hitting for par, you do much the same. And so, next time you're thinking about, when I think about carrying a position longer, going for the home run, I started thinking about putt-putt golf and how that can affect my ability to long-term make money and really get in obviously the trading terms, the highest score. And with that, we'll roll out of my thought process unless Mike has something to chime in there.
I do.
What do you think, Mike?
I do, actually.
All right, let's have you.
Let's expand on that a little bit to slow pitch softball.
I like it.
When you are the guys that ever play in a slow pitch softball game, if they're trying to hit a home run every time, 99% of the time they pop out to right center field or left center or somewhere in the outfield, they'll pop out. So with that, being an alpha male myself, whenever I always try to resist the temptation of swinging for the fences because of the fact that I don't want to pop out to right field. So to add to that, I think it's important to also add that to slow pitch softball. And here's the beauty of it. If you're down by a run and maybe the guy that's batting behind you, you know he's going to strike out and you got to hit a home run the ninth inning, well, then maybe swing for the fences in slow pitch softball. The beauty of trading is that you don't have a time clock and you don't have the innings running against you. You don't need to have the money right this second. And if you do, you really shouldn't be trading anyway.
Well, and the nice thing is when you can show that you're not swinging for a home run, and you hit kind of hard doubles to start. When you actually do go for a home run, the outfield will be in a little bit. So let's move out of that, out of my block, and into around the block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
And obviously, this is where Mike and I are going to chat about what we see going forward. Mike, and what are you watching for the week?
Same thing. Be cautious, folks. Until we can actually establish a new all-time high in the S&P, I would tread with lots of caution. I know I sound like a broken record, but I've said it before. I'll say it every day until we actually do that. Be very cautious right now.
I don't disagree, and I would add that I think Fed minutes could be very interesting. If the minutes prove to be extremely dovish, I think that could be a lead to a weakened dollar and a pretty decent rally for stocks. If they come out to be pretty hardcore, who knows? It could change things, but I don't perceive that happening. I keep thinking every time we have these sell-offs, the VIX is lower and lower, and I keep thinking we're gonna move out of it. So we'll see. So yeah, I'm watching Fed minutes. I think that could drive the rest of the week and maybe the rest of the month. So with that, we will end this episode of the Option Block. But before we go, Mr. Tosaw, what's going on at RCM Wealth Advisors?
Self-directed traders are having a ball over here, folks. If you want to trade under the RCM umbrella at either TD Ameritrade and or Interactive Brokers, or both for that matter, we do enjoy a very nice commission rate because of the fact that we have over $100 million under management. Also, we provide advice to self-directed traders on trades should you seek it. Feel free to give me a call if this is something with which you're interested in, 312-212-3531, or send me an email at mtosaw@rcmfs.com.
Love it. And here at Option Pit, if you want to check out we've got a Condors and Butterflies webinar coming up this weekend, Mike, and it's $147. You go to optionpit.com/Condor, but since you guys are Options Insider listeners, use code 25_off, OFF, all capitals, to take an additional $25 off. optionpit.com/Condors. And with that, we'll call it a show, we'll call it a day, and I'll call it a awesome success. So I want to thank everybody, and we'll see you next time on the Option Block.
preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.